Hello and welcome to the American Compass podcast. My name is Oren. I'm the chief economist at American Compass, and today we have a guest I've been trying to get on the show for a while. Very excited to be talking with Brad Setser. He is a senior fellow at the Council on Foreign Relations, former senior advisor at USTR in the Biden administration, also worked on issues related to trade and international economics in the Obama administration, and has really been working on these things going all the way back to before the great financial crisis. So I think he's someone who brings, a really great long-term perspective, especially regarding what's been going on in U.S.-China relations, what's been going on with how economists think about China and the imbalances in our economy that start in China. And I think also just today, he's been one of the most perceptive analysts of what is going on in response to everything that is happening with the Trump trade policy. So we talk about China Shock 2.0. We talk about suppressing consumer demand. We talk about where we go from here. I think a really helpful conversation for making sense of why so much of what's happening out there today is happening. Stick around for that. But first, let me tell you about Commonplace. I thought we had an especially interesting mix of stuff this week. Really liked all of it. We had a feature from Helen Andrews on the decline of the summer job for teenagers and why that really does matter. Great piece from Declan Leary on immigration enforcement and why that needs to focus on holding businesses accountable and, frankly, the shameful lack of such accountability we see today. And then I had a piece at Understanding America on tariffs and inflation and the way that the Federal Reserve seems to be falling down on the job by pretty much explicitly saying, look, we think we should be cutting rates, but we're not going to because we're worried about tariffs. That doesn't make any sense. It's exactly the sort of politicization that we should be concerned about and trying to resist if we want to have an independent central bank. And so I think, certainly an issue that we're seeing talked about a lot. So check out all of that. Of course, subscribe to Understanding America at understandingamerica.co. But right now, enjoy the conversation with Brad Setser. And here we are with Brad Setser of the Council of Foreign Relations in steamy or just sauna-like Washington. How are you, sir?
I am fine as long as I'm out of the direct heat.
Well, we will drag this on as long as possible to give you an excuse to stay in the air conditioning. Allow our listeners to sit in their air-conditioned vehicles maybe as long as possible. I've been really looking forward to doing this, to just talking with you about all these topics for a while, I think, particularly because you're someone who has sort of witnessed and participated in the evolution of thinking on global economics, trade, China, over the last 10 or 15 years from a vantage point at the Council on Foreign Relations in the Obama administration, in the Biden administration. And so really wanted to start there with just your perception on how and why things have changed. Where do you feel like the conversation was when you were starting out on all this, and what do you think has changed most and why?
I guess, I really started to focus on a lot of these issues sometime in 2004 or 2005 in the run up to the global financial crisis. I think the continuity is that China has played a central role in the debate in one form or another. In 2004, 2005, I think the vocabulary was different. There wasn't the terminology we now use, the China shock. That paper had not yet been written, but you could see the China shock in a lot of the data. But I think there wasn't. I think in this case, the academic paper and the analytics behind the academic paper shifted the debate compared to what it was at the time. The debate then was much more about whether China's exchange rate regime was sustainable. Would they be forced to revalue because of intrinsic dynamics to their own intervention in the market? And I think the debate at the time was actually much more, is this good or bad for the United States? There was a strong sense, particularly amongst American companies, that China was a sort of a positive force in the global economy. It was allowing them to produce goods, famously the iPhone, using this very efficient Chinese supply chain, which drew on a global parts supply chain, and enhanced their profits. What was wrong with that? How come that wasn't optimal from the United States point of view? Shouldn't we specialize in design and reaping the profits of our design without doing sort of the low end assembly? And that was the argument at the time. And I think at the time, the business community often didn't want to put pressure on China to change their currency regime. Um, why raise your cost? So I think it was just a very different debate, one much more focused on the sustainability of China's peg to the dollar and whether there would be a natural evolution in China's position tied to the difficulties of holding your currency down. Much more of a currency-centered debate, at least in my case.
Yeah. No, I mean, I remember even, the Romney campaign in 2012 when he first started focusing on the China issue. Currency manipulation was the buzzword. And I guess the question is, to what extent is the currency issue upstream of other things that might have been going on, or really quite far downstream of it? How do you think that's ultimately played out? Do you think that remains a part of the story that now we don't pay enough attention to, or people rightly started looking elsewhere in a sense?
Look, I think we should now be once again paying a lot more attention to currency. But there was a sort of a cycle. In 2004 and 2005, it was extremely clear that China's currency was enormously undervalued. At that point in time, China's export growth was like 3 times global trade growth. Net exports were contributing hugely to China's GDP growth. The peg to the dollar and the dollar's depreciation had meant that China had depreciated quite significantly in real terms. And the current account surplus had gone from 2% of GDP to 4, 6, 8, and ultimately above 10. So there was just an overwhelming locus of attention on the currency issue. After the global financial crisis, China did allow some movement, but they were still resisting pressure for appreciation. So the Romney campaign, I think it was accurate to continue to focus on the currency issue. In 2012, China was still holding its currency down. The market wanted to push China's currency up. After roughly 2014, 2015, when the dollar shot up, when the U.S. exited from the stalled state of the U.S. and European economies after the global and European financial crisis, and when U.S. rates started to rise, China initially followed the dollar up and then it depreciated. And once it started to depreciate, the direction of pressure on the Chinese currency changed. On net, from 2015 to 2022, with some exceptions, China was generally not holding its currency down. In some cases, it was propping its currency up. The exception was 2020 and 21 when we brought rates down to zero in the pandemic. And then what I think has happened, because China did depreciate against the dollar in 23, and because now the dollar has depreciated, and because inflation differentials have added to China's competitive advantage, I think the direction of pressure on China's currency has substantially changed in the last few quarters, and China is now holding its currency down again. So I do think it is an important issue. It is the easiest way to bring more balance to trade flows. It is the tool that every credible empirical study shows works. And it's been confirmed, quote unquote, out of sample time and time again. If you had forecast in 2022 that a 10% real depreciation of China's currency in 2023 would lead to an acceleration in the contribution of exports to China's economy in 2024, you would have got everything right. Mm-hmm. It has not been, things have evolved in ways that are consistent with the general thesis.
Right. So let's just spell out a little bit for folks who don't have as much of the kind of macroeconomic intuition here, what the mechanics of this actually are. And I think there are 2 elements. One is, what does it mean to actually sort of be controlling a currency or holding it down or propping it up? And then the second piece is, okay, and then how does that follow through? Why does it mean that if you're holding your currency down, you're well, that makes your exports more attractive and so forth. When we talk about a country, whether you want to call it just managing or manipulating its currency, what does that look like in practice? If China is depreciating its currency, if it is preventing it from appreciating, what does that mean policymakers are actually doing?
Good question. Actually, a hard question, because the way China does it isn't exactly the way people do it conventionally anymore. But it's easier in a sense to start with the second uh, uh, question you posed. Well, why does it matter? Simple answer is that if you're holding your currency down, you're keeping your products cheap. And when products are cheap, they sell. So they take market share from other more expensive producers. American companies have an incentive to get as many parts as possible from China, to do as much, hire Chinese companies to do as much assembly in China as is possible, to locate more and more of their global supply chain and global production in China. Chinese companies have no incentive to produce outside of China. They can maximize their profits by producing more in China. So when you're the cheap producer, you gain market share. So that's the basic intuition. And so when a country takes a set of actions to weaken its currency, the expected or prevent its currency from going up, the expected effect is that you keep your exports cheap and you sell more.
Right. And I
Now,
guess, well, sorry, just one other piece on that. I guess the traditional theory would hold that if one market response is going to be, if you are the country that has exports surging, that is generating a large current account surplus, that is in effect going to cause your currency to appreciate because of the demand for it to buy the stuff. And so it was seen historically as something of a kind of self-regulating mechanism. You know, when you go back to the Hayeks and Krugmans of the world saying these things are sort of self-correcting, trade deficits kind of come out in the wash, one of the mechanisms was an assumption that, well, you can't just run China's kind of surplus forever because your currency will appreciate as a result, and that will counteract it. And so part of what you're seeing is, in effect, China, by proactively preventing that from happening, therefore maintains and even expands its surpluses, sort of in contravention of what you would have expected the market to be doing.
I mean, there's a super strong version of that, which is that if you are holding your currency down by buying foreign assets, you're going to expand the domestic monetary base. In practice, this doesn't always happen quite like that. And the expansion of the domestic monetary base will lead to inflation, and that'll push your costs back up, even if you don't let the currency move. Now, Krugman would say that that is empirically not what happens. That if you don't allow currency movement, typically there's not a big enough change in inflation to self-correct. But there was generally a sense that this was self-correcting, and so therefore one shouldn't fight a trade war over it. That was George W. Bush's policy. He didn't name China as a currency manipulator in 2005, 2006, 2007, 2008. Hank Paulson certainly didn't want to name China as a currency manipulator. We didn't actually use any of the negotiated within the WTO special safeguards to counter the surge in China's exports at that time. There was a very, very strong belief that this was going to be self-correcting, or some combination of it's going to be self-correcting, and it's in our interest.
Right.
So therefore, we shouldn't use even permitted trade remedies. So I mean, if you want to talk about things that have completely changed, that has completely changed on a bipartisan basis. But the mechanics of how China does it, how China holds its currency down, is relatively straightforward. The trade surplus was generating a lot of foreign currency. The exporters generally at that time wanted to sell that foreign currency for the Chinese currency. And that would have naturally meant a bid for the Chinese currency. China's currency should have started to appreciate. China's central bank came in and bought the dollars, preventing that appreciation. What has happened over time is that China's central bank does less and less, and certainly does less and less visibly. It may be still buying, but then it hands over the foreign exchange to one of its policy banks or to one of its the state commercial banks, so you don't see it. What you now see are Chinese state banks acting to stabilize the currency. And at times that has meant keeping the currency from falling. Right now, I think it means keeping the currency from rising. So what you're increasingly seeing is that the management has been outsourced to the state banks. And the state banks are essentially doing what China's central bank used to do, and presumably at its direction. I think there's been very good reporting in 22 and 23 that the state banks were, in effect, drafted by the PBOC to take action to, at that point, support the currency, and I assume now to hold the currency down.
And the result that we're seeing is that China Shock 2.0 is now bubbling up as the new fashionable term. You're seeing a little bit to your point that you had this sort of one era in the 2000s, things looked a little different in the 2010s maybe, and now we're back to another sort of unprecedented surge in Chinese manufacturing investment, capacity expansion, export growth. How does that look? How would you compare the magnitude of it to what we were seeing in the 2000s? And in what ways are the causes the same or different this time around?
Well, I actually think it's important to discuss some of the evolution that happened after the global financial crisis. I think that directly led to the China 2.0 shock in some important ways. But to jump to the conclusion, I think the magnitudes for now are very similar. I think it is being felt less by the U.S. than by others, partially because we export less, which isn't great, but is a reality. And so a lot of it is China displacing machinery, construction equipment, cars from markets around the world, Brazil, South Africa, so forth and so on. But magnitude-wise, for the global economy, similar, maybe less for the U.S. because we don't export as much, and we've done a better job of protecting our auto industry, and a lot of it's around autos.
Yeah, well, so
But
go back to it's an interesting point. Go back to the sort of middle. How does the intervening period sort of set the table for what's happening now?
so in the years after the global financial crisis, China did let its currency adjust up, and its current account surplus did fall. Didn't go to zero, but it did fall. It was substantially lower in the years after the global financial crisis than it was before. And that's partially because of the currency adjustment. It's partially because the U.S. and European economies weren't growing that fast. And it is also partially because China just threw a lot of money through its state banks, through its local government levels of government, into building out its infrastructure and its property sector. This is the era when Chinese property developers kind of go crazy. And that absorbs all the steel that China's enormous steel industry is generating. That puts a lot of excavators at work in China, so they're not exported globally. It allowed an equilibrium where China grew pretty fast without relying as much on net exports, without relying so much on external demand. The problem with, and this is also, frankly, the period when global companies start looking at China as a market, because China's growing faster than the US and Europe, and they discover that China is in practice a very closed market. And they cease to look at China just as a source of cheap supply for the US and European markets, and start to look at it as a market in its own right, and discover Xi in particular has no intention of letting foreign companies reap a lot of the profits in China's domestic economy. So there's a disillusionment on the part of the business community, which is very palatable. But the problem with all this was that this property bubble, which allowed the adjustment, didn't turn out to be sustainable. It went bust, triggered by the so-called three red lines when Xi tightened up on some of the regulations around property development lending, trying to kind of prick the bubble without bursting the bubble, but ended up bursting the bubble. China's property sector has been in the doldrums since 2021. And as a result, two things happened. One is that China's economy became much weaker. China's not growing that much faster than we are typically now. And some of that growth is probably fake. It's inflated. And some of that growth is coming from exports. So if you look at the domestic side of China's economy, it's not growing as fast as our economy. That contributes to the China shock because it creates a global environment where Chinese companies and foreign companies in China aren't seeing demand internally and have to look abroad. And it leads to a relatively weak Chinese currency. The central bank is cutting rates. When we have an inflation problem, we're raising rates. the currency falls back, China becomes exceptionally competitive. So that's factor A. Factor B is that a lot of China's industrial policies kind of suddenly start yielding results. China had a long time goal of building up its own indigenous is the Chinese term for Chinese controlled intellectual property, Chinese owned companies. So Apple in China is not an indigenous company. It may be active in China, but it's not indigenous. China wanted its own indigenous electric vehicle industry, both Chinese companies with Chinese intellectual property making electric cars in China. And shock of all shocks, they kind of succeeded in that sense. Now, these companies may not be enormously profitable, but they are Chinese-owned companies with Chinese intellectual property, and they have dominated the domestic Chinese market, outcompeted Tesla at home, and they're now exporting a ton of EVs. And then, because their production ramps up so fast in China, because every locality wants to support its own local champion, sets up its own local company, puts pressure on the local banks or the local branches of the big state banks to lend. And, in some cases, there are credible reports in the New York Times that Chinese and maybe VW have effectively been gifted a full factory built to their specifications as an incentive to put that factory in a given province or a given locality. So you combine all this, you got a successful industrial policy, and China is suddenly competitive in exporting a whole range of new technologies, electric vehicles. They catch up in wind technology. Their dominance in rare earths becomes dominance in permanent magnets, which are really important to an efficient wind turbine. Obviously, they take over the photovoltaic, the solar industry. And then in less sexy things like, hey, old-fashioned excavators, less real estate construction in China means less demand. There's a bunch now of Chinese-owned companies, not just Caterpillar in China, that are producing quite good construction equipment. And so all of that starts getting exported. And then I think the final thing is that when property investment falls, there's a very conscious policy of directing the state banks in a very old-fashioned way. Forget all this talk about reform. It's a quota, is you will do this. You have these kind of guidance targets. But the guidance was you need to lend more to manufacturing. You banking system, which is still state controlled, need to support investment in manufacturing. And so you see a surge in credit to manufacturing, a surge in investment in manufacturing, which in the short run helps stabilize the Chinese economy, but it leads to this expansion of China's productive capacity. And I think the thing that has now changed compared to when I started is that China, with a few exceptions, super advanced semiconductors, the equipment to make the most advanced semiconductors, commercial jet engines, I'm sure there are a few others, but for most of the goods, industrial goods that the US, Europe, and Japan make, China is a credible competitor at a lower cost point. Back in the early 2000s, China was doing final assembly, it was doing clothing, it was doing furniture. It wasn't at anywhere close to the cutting edge of industrial technology. And in some sectors, China is clearly the leader in battery chemistry and permanent magnets, so forth and so on. And in production efficiency and technology, deployment of industrial robots, China is kind of the leader. So I think what the big thing that has changed is, on one hand, there's a lot more Chinese competition across a full subset of industrial sectors. At a price point that in general the U.S. and Europe cannot match, in part because of the currency issue, and then there is a sense, and I think it's more than a sense, that China's capacity expansion isn't constrained by the normal laws of supply and demand, the need for firms to make profits. Because there is so much local government support, because exit is blocked by the local governments who've supported these companies, because there are much longer lines of credit to support losses, and because Chinese equity investors don't expect the return that American equity investors expect, China can just kind of force other companies out of certain industries And thus, there's a credible possibility, given China's size, given its concentration of in manufacturing, that it can kind of wipe out production outside China in an entire sector. That happened in solar. And so a lot of the debate now is, do you want that to happen in other industries?
Right.
And so I think the sense of Chinese supply creating a set of vulnerabilities and strategic vulnerabilities is an important shift. And that has taken place over the past 10 years.
Yeah. So this raises two questions for me. One on the consumer side, one on the producer side, maybe. On the consumer side first, a lot of folk who are doing a good job sort of telling this story of what's going on, where these imbalances are coming from, will use various forms of the formulation that sort of China suppresses domestic demand. Like that there's something going on here. Why aren't we seeing the more natural kind of growth where, well, China's getting richer, so they have a bigger consumer market, so they buy more stuff from the rest of the world, right? Like everything China's doing would be a lot less concerning if in return for everything they wanted to send out, they were buying a whole lot of other stuff back from people. Do you think, is that the right way to describe the sort of the crux of the imbalance? And how does that work? What does it mean? Why has the Chinese consumer not emerged in a sense?
Well, some people say the Chinese consumer has emerged because they look at, China's economy, not in the past few years, but up until 21, was growing faster than economies around the world. And Chinese consumption growth was on a absolute scale faster than in most other economies. It just wasn't keeping up or exceeding the overall expansion of China's economy.
Mm-hmm.
But I do think it is an important observation. There is a growing consumer market in China. It just isn't a growing consumer market that is growing sufficiently fast to keep up with China's productive capacities as production. So I think there are two components of the general concern. One is China doesn't import. Well, let's be clear, China doesn't import manufacturers. They've generally still had to import commodities. Now, that may change with electrification, but China imports oil, it imports iron, it imports copper. So for the point of view of those economies around the world that basically specialize in the extraction of natural resources, at times China's been a very positive source of demand. But on the manufacturing side, particularly over the past 10 or 15 years, China's growth in manufacturing imports has consistently lagged growth in the overall economy. Imports are falling as a share of GDP. Imports in dollar terms now, manufacturers, are essentially flat from 2017 or 2018, which is a strange result because exports are up over $1 trillion. So, it's like kind of you're exporting, but you're not importing in the manufacturing sector. So that's part of it. And that's a function of, Xi talks very openly about wanting to have complete industrial supply chains inside China. Made in China 2025 more or less said, here are sectors where we now import. This is back in 2010, 2011, 2012. We want a plan to displace those imports because we don't want to rely on other countries' production or their technology. And China, to be fair, their state-guided, state-directed approach has achieved some successes in moving China closer to the technical frontier and expanding Chinese production in those sectors, sometimes at a very high cost. But it has achieved those goals. The second important sense of China's holding down consumption, it's not really holding it down. It's just not supporting it. China has, for a long time, had a very high national savings rate. Part of that is Chinese companies do make some money, and they plow it back into expanding their productive capacity. But Chinese households just generally save quite a lot. And that's true for high-income households, and it's true for low-income households. Now, what China doesn't do is tax high-income households to send checks to low-income households. We have the earned income tax credit, which is essentially a negative income tax. If you are in the workforce, you get a check to support your salary if you're not making very much money. And we have more or less a progressive structure on our income tax. So the more you make, as long as it's not capital gains, the more you pay. China doesn't collect much income tax, only 1% of GDP. We collect 6, 7, 8, I forget exactly right now. Very, very low. And so it doesn't have much capacity to do redistribution. It gets most of its tax revenue from a value-added tax, which is a fairly regressive tax on consumption, and from social contributions, the equivalent of our Social Security and Medicare payroll taxes. But the way those social contributions are structured is that when you enter into the formal labor force, there's a big buy-in. As opposed to 2% of your income or 6% of your income, it's like a couple $100 and then 2 or 3 or 4 or 5, 6% of your income. So there's kind of like big, heavy burden on the lower income workforce, that reduces take-home pay and reduces consumption. And then, so you have a tax system that kind of penalizes or doesn't support the income and thus the consumption of low-end work. You have a social safety net, which is very funded through provincial and local governments. Unemployment insurance is not provided at the national level, which means that the weaker provinces, the poorer provinces, can't offer very much. You have a health insurance system, which has a high out-of-pocket cost. And in some cases, you're supposed to get reimbursed. But if you don't have the money to put up to pay the doctor, and you're not going to get the care, even if you eventually will get reimbursed. And in some cases, because the doctors don't get paid that much, there's an expectation they'll get a little extra on the top, which of course you have to cover out of pocket. So you combine all this, you combine kind of the social need to have an apartment if you want to be a part of the marriage market in China and the cost of housing, you get exceptionally high savings rates, which means that as a share of China's economy, consumption is quite low. And it's not a big enough part of the economy to propel China's economy forward at the pace China wants to grow. And it means that the productive capacity of China's economy gets directed to the rest of the world.
Right. Interesting. And so then to the productive side, Ben, everything you were describing about sort of explicit policy, the kind of different incentives in some cases that are allowing Chinese manufacturers to invest and expand so aggressively, in some respects, it sounds like that should be a bubble in its own right. Like one might say, this isn't sustainable. You are expanding capacity in ways that do not cover their cost of capital. This is all sort of a house of cards that's going to come tumbling down. Or you could look at it and say, well, actually, if you're backed by the authoritarian government of a, billion plus person economy, actually, you can sustain this for as long as you want. How do you think about that piece of it? Is this sustainable? Is there a sort of logical point of diminishing returns or point where it breaks?
Well, we've seen, in a sense, that you do ultimately hit limits. And, China's solar industry is now hitting those limits. China has driven down the cost of solar. It has expanded the market. It nonetheless has the ability to produce so many solar panels and the precursor cells that none of the Chinese producers are making money. And there is no more kind of export market to take to absorb your capacity because you are the global supplier. There's a few protected niches where that's not true. But in general, China is an enormous share of the global panel market and solar cell market. So you can only absorb. There's no way of taking market share and forcing other companies out of the business. You are this global supply, and you nonetheless are producing 2 times what the global market will support. And you've already cut your prices below your cost of production. So now you kind of have to force parts of your domestic industry out, and you kind of have a bloodbath to decide between provinces, between companies, so forth and so on, who's going to get forced out, who has the deepest pockets. So yes, there are limits. I think the problem for the world is that in a lot of cases, those limits, the natural limit, comes when China has completely taken over production in that sector, driven companies that need a positive return on capital out of the market. And so that, to me, is the problem. When you get to the natural limit, that natural limit comes when China has achieved effective control and has created, as I mentioned, strategic vulnerabilities for others, as well as, driving producers in important sectors outside of China out of the business. The best example, the most prominent example is autos. Right? China had 2017 the capacity to make 40 million cars domestically. All of them were conventional gasoline powered or diesel engine cars. EVs were trivial then. 40 million is little less than half the global market. The global market is like 85, 90. The domestic market at that time was somewhere, there were some incentives. It was maybe a little frothy. A lot of people were buying first cars for the first time. That's bad English, but it was like a little over 25 million cars, maybe got up a little higher. China's a big part of the global market, but now it's sort of stable at around 25 million cars a year. There was overcapacity in that sense in the internal combustion engine car side of the Chinese market. And at that time, there weren't that many exports. A lot of it was through JVs. Ford doesn't want to produce in China for selling back to the US if it has to split the profit on its cars with its Chinese partner. So the JV structure impeded exports. Now, in most countries, you would never been able to build an EV sector that now can produce, by the end of this year, 25 million cars when your overall automotive sector was already oversupplied. But China did. So now China's going to have the capacity to produce 25 million EVs. It's probably lost 5 million, who knows, in internal combustion engine capacity. But it clearly has the capacity to produce 50, 55 million cars and a domestic market that's still 25. And so just incrementally, China's in a position to meet all global demand and force other auto producers out of markets if they don't protect themselves. And so, it just becomes, has China hit the limit? Well, maybe not. I mean, the ultimate limit is China produces all of the world's cars. I mean, China for a while, was producing all the world's iPhones, produces all the world's solar cells. But there's not a political willingness, in my judgment, in either the United States or Europe, not to produce cars. So then you have to come up with a solution. And there's, I think, some difficulty, particularly in EVs, because those parts of the world, which is no longer includes the US, and I think that's a mistake, but say Europe, you want to grow your EV market. You want more and more electric cars on your roads for a host of reasons. China already has the capacity to supply that incremental demand at a lower price point than your own companies. How do you get them to invest in expanding their EV production when they're competing against China, which already has that capacity and can produce at a lower price? And that is a problem in sector after sector after sector, and why some of our, the Biden administration's industrial policy efforts kind of failed. We maybe will succeed now in rare earths and permanent magnets, but it was really hard to get private companies to go into a market when China was already oversupplying that market and you couldn't match them on price. You just didn't see the profit.
Yeah, the magnet example is a good one there because it was a place where I think what a lot of policy folks have seen and is encouraging to now see in the most recent Pentagon deal is you both need the capital incentives and basically the price support. Like no amount of capital incentive is going to get any capital investment if you still think you're going to just get undercut by a flooding of the market from China. I guess though
that means it's expensive. That's the downside. But yes, I think that's for things which are critical. And right. We now know permanent magnets are critical. They have we've known for a long time they're used in radars, and now we know they're used in missile guidance systems. They're slightly different permanent magnets. They are actually strategically important. There are other things that are strategically important where we need to follow that model, in my view.
Well, I guess the question would be, is the auto industry strategically important? I mean, it's not strategically important in the missile sense, although it may be to some extent in the do you actually have an industrial base at all sense. But I guess a challenge for policymakers now is, okay, well, what is the rationale in different contexts for saying we will not allow ourselves to just be flooded by Chinese overcapacity? And it seems to me there's a perfect segue to the last thing I wanted to ask you about, because all of this is playing out in the context of obviously everything the Trump administration is doing on trade, what seems to some extent to be an effort to force the rest of the world to accept U.S. terms or else work more closely with China. And you see a lot of countries sort of saying like, oh, well, maybe we'll go do a deal with China instead. And I think you've probably better than anybody been pointing out well, but if you look at the surpluses everybody's running, there is no way to do a deal. To what extent do you think people have internalized that conflict, and what are the possible resolutions of it? It seems somewhat irreconcilable.
Well, ultimately, the reconciliation is a more balanced global economy where China doesn't need to run this big of a surplus, and whereas neighbors are not also running surpluses. The ultimate resolution is a more balanced Asian economy that doesn't rely on non-Asian demand, and equally a more balanced American economy that doesn't rely on predominantly Asian outside pharmaceuticals supply. The challenge of doing a deal with China is that China is not a very good import market. So if you're going to replace the U.S., which is a very good import market, with China for manufacturers, so setting commodities aside, with China, China is a much, much smaller market for manufacturers writ large in dollar terms, and B, it's shrinking. China's auto imports are going down. Its imports of almost every manufacturing category are going down. China's policy goal is to not import as many semiconductors, to not import as many aircraft. So, there's just not Chinese demand to make up for U.S. demand. And from a macro equilibrium, if a bunch of surplus countries get together and form a trade deal, they still have a surplus that they have to export outside that circle. And the biggest source of net demand for goods right now, well, first, by far the biggest is the U.S. Way below that are the U.K. and India. So the only natural partners for surplus countries would be the U.K. and India. India doesn't want to become more dependent on China, so that's kind of out. Who knows about the UK? They say we've done a deal with them. They also say that China is still central to their image of future growth. But I do think this realization is starting to seep in, partially because the Europeans got mugged by reality over the past 5 years. Europe has discovered that the threat to Europe from U.S. protection is that with less access to the U.S. market, China will sell more to Europe. And that became a reality over the past few years. And that is starting to, that generated, you could argue for parts of the European economy, like Germany, there wasn't a first China shock. For Italy, there was, but for Germany, there wasn't. It was just positive. They needed Germany's machine tools. Wealthy Chinese entrepreneurs discovered that they could afford a BMW or Mercedes and they wanted one. So for up until 2015 or so, you could say China was a positive shock to the German economy. But recently, it's been a very negative shock to the German economy. And in some ways, the more you sell to China, the more vulnerable you are. And so Germany's, because it was successful, has been more exposed. And it's taken a real serious hit from the second China shock. So I think that recognition has seeped in to the European debate. It hasn't led to a full sea change in European attitudes on all policy questions. But there is, just in the same way, the U.S. debate on China in 2006 is fundamentally different from the U.S. debate on China in 2025. In 20 years ago, we weren't talking about strategic vulnerability and China's capabilities surpassing our own in key sectors and worrying about dependence. We were worried about an undervalued exchange rate and excess Chinese demand for treasuries and what it might mean if China pulled its bid out of the treasury market. But we weren't relying on China for permanent magnets. We weren't relying on for battery chemicals. No, drones weren't even a thing. So we weren't worried about drones and who makes drones and how that would impact future warfare. The answer to your question about autos is that we do need a manufacturing, and I agree with you, we need a manufacturing industrial base where there's enough internal production capacity that you're not just relying on the military for all the little components that you need to make a tank or to make all the things that move people and arms around. And also there's a little bit of overlap with aircraft. And you need machine tooling and you need precision in handling metals and making metal parts. So and chemistry, you need a battery industry if you're going to make drones. Certain kinds of drones, not the jet engine ones, but the quadricopters. So you do need this more generalized, diverse manufacturing capability. And so the sense that we were vulnerable in that way is, to me, an enormous shift.
Yeah. So last question for you, insisting that you put on your prediction hat or at least forward-looking analyst hat. We seem to be in a world of something's got to give. That either the U.S. could abandon its current posture and say no, we will continue to be the world's sort of absorber of surpluses. China could in fact accept that it cannot continue down this path and either needs to rein in its producers or accept more imports. Europeans, India, and UK could either decide we're going to stand up to China along the side the U.S. or we're going to abandon the U.S. and become absorbers of surplus for China and the other East Asian economies. What seems more or less likely to you? What seem like the non-negotiables here versus the places where we're likely to see movement in the coming years?
Look, if you just look at rhetoric and forecast, the rhetoric and forecast has been we have a political consensus to be less dependent on China. I mean, that was true in the first Trump administration. It was true at the beginning of the Biden administration. It is true now. That, there is no political force in the United States that comes up and articulates in public the case for becoming more dependent on China for our manufactured supply. Maybe there are groups that want to protect existing sources of supply, but there isn't a case for a bigger imbalance because our companies are getting all the profits from it, because we want cheap goods, and because in a globalized world, no country is going to use embargo or technology controls, export controls to try to gain strategic advantage. That the notion that you can just trust China and don't have to worry about vulnerability has disappeared. The desire for balance is consistently expressed. Yet so far we've made very, very, very little progress. The Trump Term 1 tariffs made the mistake of thinking you could solve every problem with a bilateral tariff. You can't. You need an industrial policy, and it's easy to get around bilateral tariffs. People talk too much about transshipment. It is shipment of parts for final assembly, which is a substantive transformation. It is perfectly legal. That is the way the rules work. But if you just tariff bilateral direct trade, you're not going to stop the Chinese export juggernaut. You're going to get the parts just through third parties and the goods, which have embedded dependence on China, through third parties. So I agree that you need a more broader approach to do that. The problem I see with the Trump administration's policy is that they seem more intent on building a tariff wall that's high vis-a-vis everyone, independent of how much Chinese content is coming in, than building a wall around China that locks China's production in China. I mean, we do not import a lot of embedded Chinese parts from Europe or from Canada. We actually don't import that many embedded parts from Mexico. Some, not that much. Only computers. Like the Mexican autos are not Chinese Trojan horses, at least not yet. Mexico imports a lot of cars from China, and then Mexico makes a lot of cars to sell to the U.S. So there's a kind of displacement issue. But the Chinese component trade, that's fundamentally Southeast Asia and Taiwan. A little bit Japan, mostly Taiwan, Southeast Asia. So, building these tariff walls on everyone, which is mostly impacting their own production, makes it much harder to get everyone's support to build a tariff wall around China. So that's problem one I see with the current approach. I agree that you couldn't just use bilateral, but I think we've gone to the opposite extreme where we're building a wall around our entire market, not just around China's market. Mm-hmm. Problem number two is we're not doing the industrial policy. I love Mountain Pass. I love that investment. Should be doing more of that. But this administration is not very enthusiastic about the CHIPS Act. They think you can do too much with tariffs. They don't recognize that you need some of these incentives. But then finally, there is this macroeconomic component. We are supporting our own demand. We are going to have to go out and borrow a lot of treasuries, sell a lot of treasuries. We can't sell all those treasuries domestically. If you're importing the world's savings, you're going to import the world's goods. That's a basic macroeconomic identity. And until we find a way to do a bit of fiscal adjustment, And frankly, that means taxes, not just spending. We are going to still rely on the rest of the world. We can protect sectors, but we're not going to change the underlying dynamics. We will put taxes on trade. We will export less, but we will import less, but our trade deficit is likely to stay the same. And I think you can say the same thing with China. They say, they want a complete internal supply chain. They continue to subsidize their key sectors. She just doesn't want to send checks to consumers. He's allowed a few provincial trade-in schemes where you give up your old dishwasher and get a more efficient new one, and the local government pays for that. But he's not done the sort of systematic shift in policy where you tax income more, high-end income more, where you provide a lot more support for a more generous social safety net to bring down savings, where you're willing in a pandemic to send out checks directly to households, which she didn't do, where you change the structure of taxation so it weighs so much less heavily on your low-income populations, so they don't have to save as much and they have more income. He's not willing to make those changes. So to be honest, my fear is we're going to keep talking like we want to de-risk, talk like we want more balance, and not put in place the policies that are needed to get there on both sides.
Well, that is my fear as well. We will watch with bated breath. I will await your next set of charts on X with bated breath. And really
I had a pretty good set of charts and a good blog on how China's intervening to hold its currency down. That this is an important change that I don't think has gotten enough recognition. So I do recommend that.
Yes, we will put it in the show notes. We will send everyone to the blog and the X account. Brad Stitzer, so thank you so much for making the time to join us.
Yeah, my pleasure. Thanks for giving me a chance to go back through my own personal intellectual history and a lot of our collective shared international economic history.
And we will be back again soon with another episode of the American Compass Podcast.